Welcome to the first Redwood Money monthly client update. Each month, we'll use these updates to answer some financial planning questions that I've gotten from clients, share some insights on things that I'm thinking about as your financial advisor, and give updates both on what's happening in Redwood Money and some personal updates. I'm really excited to be giving this particular update because it's the first one. And those of you who know me well know that I've been dreaming about starting this business for a while. And it feels like such a culmination of many things. And I'm so grateful to be at this spot. You can see Sophia here on the screen. We were up in Tahoe with her this last weekend. And really, from a month before she was born until now has been this saga of becoming a dad, of quitting my job, of filling out paperwork. And now I'm finally at a stage where I'm getting to do what I really have wanted to do, which is do full-time financial planning for people I love and the people they love to help them to make smart, strategic financial decisions that are based on their values and hopefully have better financial outcomes because they've got me to be their trusted money coach, walking alongside them through the different money milestones that they're chasing. And so as we get started, I wanted to jump right into the biggest question that is on the minds of me and of many clients who have been asking about it, which is about whether or not we should be concerned about the recent market volatility that we've seen over these last few months. Let's jump in. So over the last few months, really since November 4th, when the stock market was most recently at all-time highs, we've seen this really steady and sometimes dramatic decline in stock prices. And I've been getting questions from clients because while the market is down around 10%, there are many individual companies that are down much more than that. And we'll talk more about why we diversify later on that point. But it's a really valid question. And I think we were a little bit put to sleep by what happened with COVID, which is there was this massive crash right at the beginning of COVID, and then a lot of government stimulus and spending that propped up markets. And since then, it's been a fairly low volatility time. And so we may have kind of forgotten what it feels like to look at an account balance and actually see that it's gone down because we became so accustomed to housing prices going up, to stock prices going up, to crypto prices going up. And now over the last few months, things are going down and it does not feel good. And my hope with this next section is really to not just look at the specific situation that is going on right now that's led to this market volatility, but rather to give you 4 ideas about market volatility that will help you not just for this correction, but for future corrections that will come. Because I know that this is going to be a regular conversation that I'm having with clients, because what we know is that stock market losses actually happen fairly regularly on the way to earning higher returns. And the first point that I want to make is that stock market losses, like we've seen over the last couple of months, are actually completely normal. Ben Carlson, a financial writer, did an analysis of the 500 largest companies in the US, this index called the S&P 500. And he saw that between 1928 to 2021, that in 95% of years, at some point during the year, there was a decline of at least 5%. Now, stocks may jump back before the end of the year, but at some point during the year, there was at least a 5% loss. And in 63% of years, so over half the time, we experience what we've experienced over the last few months, which is a loss of at least 10%. And in about a quarter of years, once every 4 years or so, we experience a bear market of a 20% decline or worse. So what we're seeing is incredibly normal. Now, you may be wondering, Jeff, if this is the case, why would I invest in something that does this? And the reason is because we never want to lose sight in the midst of this short-term volatility of the benefits of investing in businesses. And so let's look at the big picture. This is what happened during that same time period with all of those losses you see between 1928 and 2022. $100 invested in the S&P 500 during that time period grew by 86,700%. So from $100 to $867,000, an average return of 10.16% per year, in spite of that volatility. And why is that? It's because as a stockholder, you own a share of a business, and that share of the business gives you a share of any future profitability. And what we've seen over the last 100 years is these incredible profitability and productivity gains that have accrued to the benefit of long-term investors, of people who have been able to stay the course in the midst of the volatility of any given month and stay invested. Now, here's the difficult thing, and my job as an investor is to show you this chart. But what the media, which has a very loud megaphone, wants to do is they want you to watch this chart. This is the 1,128 months between 1928 and 2022. And you can see all those red bars, those are months where the S&P's monthly returns were down. The blue bars are the ones where it was up. During all of that, we've seen these enormous gains, but they only benefit people who can hold on for the long term. And I'll share a little bit later about how we hold on for the long term. But the media specifically wants you to see this because their business model depends on getting people's eyeballs on a screen. And as people, we have a behavioral bias called loss aversion, and it makes losses twice as painful as gains. So when you look at your stocks and you look at your 401k and the statement says the value went up, you feel great. But when you look at it and it went down, you feel twice as bad as you feel good when it goes up. It makes you maybe panic. It makes you concerned. And we count on our investments to fund future things we're excited about. So it's no surprise that the media preys on this tendency. And instead of showing you the chart where everything goes up, they show you whatever the issue of the day is. And so let's talk a little bit about the issues of the day and how that could impact our investments. Right now, there's a reason for what's going on. And oftentimes what basically happens is the news cycle of the day, which today is inflation increasing, the Fed raising interest rates to combat inflation, maybe some geopolitical stuff with Russia and the Ukraine or with China and Taiwan, and a huge manner of other things, quarterly business results that are coming in, COVID supply chain issues, all of this stuff impacts stock prices. But what I want to point out, because we're going to have a new issue next year and the following year, is that the reason is always changing. And if you want to look for reasons to be concerned or be pessimistic, you will always be able to find them. And so will the media. They'll be able to find a talking head who has a reason to tell you it's not a good time to be in stocks right now. But this chart looks at some of those headlines. It looks at a couple of times where we saw the S&P 500 down almost 50%. US inflation hitting 13.5% in the late 80s, right? COVID-19, you can see way at the end, but what do we see throughout this? That green line is the growth of a dollar invested in world stocks between 1970 and 2020, growing from $1 to $80 as companies continue to chug along to produce profits for their shareholders, and those who can stay the course are rewarded. Now, you look at this chart and you may think, well, Jeff, why don't we just sell at the high points and then just buy back in at the low points? Couldn't we make much more money? And the answer is yes. And if you have a way to do that, let's do it, because I'll make a lot more money as a financial advisor figuring out how to do that. But the fact is, John Bogle, who's a famous investor, he said not only did he not know anybody who could reliably time the market, he didn't know anybody who knew anybody who could reliably time the market. And part of the reason why is because the best days in the market often follow the worst days. So it's not like you sell one day and then the stock market falls for the next 10 consecutive days and then you buy back in and there's really clear indicators. Oftentimes there's this whipsaw effect where news hits, stocks fall, then some new news hits and they rise again. And even this last week gave us an example of this. And you could go back and you could find plenty of examples, but let me just give you one from the previous week in technology, which is near and dear to my heart as a Silicon Valley native. But let's look at what happened this week. So on Wednesday, this is the week of January 31st, Facebook stock reported earnings, and Meta Platforms now is what Facebook is. And you can see here they had a really tough day. After the market closed on Wednesday, stock had been steadily rising into earnings. They report their earnings and they missed their targets, and they also reduced their future projections for profitability. And the stock fell between Wednesday and Thursday by 26%. And markets are very good at pricing in new information. So that fall, you can see it is almost instantaneous. There was no way to get out of the way of it. It was a look out below moment for investors. And it didn't just impact Facebook. It also impacted other technology companies because Facebook cited issues with how Apple is handling privacy and lower ad spend by companies, which made people concerned about maybe people are investing less in advertising. And so this next chart looks at Amazon. So Amazon is very interesting. You can see on Thursday, the stock price dropped. It dropped over 8%, basically based on the Facebook news. And the NASDAQ, which is an index of all technology companies, it dropped 4% on average on Thursday. So Facebook down 26%, the NASDAQ down 4%, Amazon's down. But then what happened on Thursday that caused this jump back up? Well, Amazon reported earnings and they had great earnings, and the market instantly priced that in after hours. And you can see that today, Friday, the stock went up 15%. And I think this is interesting to look at because if somebody had just slept through Thursday as an Amazon investor, they'd be like, this is great, I'm up. But if you're checking your phone all the time or your Robinhood app or your account balance, this was a stressful day for you. And part of the thing that I can do as your advisor is I can be the guy who's looking at equities, who's providing advice, who's answering your questions. And it hopefully takes some of the pressure off of you to feel like you need to watch this closer. Because while many companies make money for getting you to trade into and out of securities, that's not my business model. And I don't think that that is the strategy that benefits most investors. What you can see here is the NASDAQ basically was flat for the week. It was very choppy, but ultimately it closed about where it started, even though there was a lot of drama. And as an investor, if you had just not paid attention to the drama, checked your balance at the end of the week, you would have been fine. And so I point this out to make the point that it's very difficult to time the market, that there's constantly news that's coming in. But if we go back to that chart, remember, plus 86,000% over many years, if you can stay the course, what are companies like Facebook, like Amazon, like Apple, like GE, what are they going to do? They're all incentivized to continue to increase profits for shareholders, and they are going to find a way. And the ones that can find a way the best will do very well, and the ones that can't will go away. And if we invest broadly among them, then you're going to experience the overall average of those returns. And so let's finish with one final point on this, which is what can we do about this? I would say that a good financial plan has some volatility guardrails in place. And here are some of the things that I do for clients, and you'll recognize these as parts of Right Capitalist, things that we've talked about. And this is the first thing. We're going to keep short-term money out of the stock market, out of these volatile asset classes. If you need money for spending, well, that's going to stay in your checking account. And we're going to make sure you always have enough for your everyday expenses. If you need money for unexpected expenses, that's your emergency fund. We're also going to keep that out of the market in a savings account, like a high yield savings account. What about if you have a plan to remodel a home or buy a home? Well, we're going to take that out of the market as well. Even if it's 18 months away or 2 years away, we want to make sure that that money is set aside and it's not volatile so you can sleep well at night and you know that it will be there when you need it. Now, will you get the same growth as what you experience in stocks with that money? No, but it's short-term money that we want to protect. Now, the second thing we're going to do for these volatility guardrails is we're going to keep long-term money in long-term buckets. So for many clients, a bulk of the money that they've saved for the long term is in accounts like an IRA, a 401k, a Roth IRA. And what's great about these retirement accounts is while you can trade in them, there are stiff penalties if you withdraw money before you're about 60 years old. And even people who are older than 60 or on the verge of retirement, they're not going to take all of their money out of these accounts at once because there would be tax consequences of doing that. Often in a 401k, you'd pay a lot of income tax. What this does is it keeps you invested for the long term. And we're going to put that money in long-term buckets that we know can be invested, and that's an area where we can be more aggressive. Why? It's because we want to make sure that you can maintain your standard of living now, long into the future, and in the future, everything is going to cost more. And so you're going to need more money to fund it, and the best way to do that is to invest in asset classes like stocks that are going to increase over time. What's the third way that we deal with volatility? Well, we're going to diversify broadly. Now, diversification, it can't guarantee you against loss, but it can reduce your risk. And how does it do this? It's by not having all of your eggs in one basket. So we're going to diversify within each investment type. What I mean there is if we're investing in US stocks, it's not going to all be in any one company. Even if we love a company, even if we think that it's got great prospects, we're not going to put an inordinate amount of your net worth in any one company. We're going to invest in funds that invest in hundreds or thousands of companies. And what that means is you're not taking too much risk on any one company and its prospects. We're also going to invest among investment types. So you've got US stocks, but what about international stocks? What about real estate? Bonds. Bonds is a huge asset class because it's an investment in debt, and governments, companies, cities, all of these organizations, they raise money through debt that you can buy as an investor. And bonds are a great way to diversify the risk of stocks because when stocks fall, bonds tend to fall less. Because as a bondholder, you are basically guaranteed that income stream unless the entity that's paying you goes bankrupt. So when you buy bonds from a government or from a really secure company, oftentimes those are going to be much less volatile because even if the company's not profitable, they're going to pay their debts in order to not go bankrupt. So as you get closer to retirement or if we need money near term, that's a safer asset class to invest in. Now, this third element of diversification is one that's not often talked about, but that I love, and it's diversifying across time. And that's really this idea of instead of putting all of your money into an investment all at once and hoping it goes up from there, which can be fairly anxiety inducing, we're going to invest steadily over time with multiple different entry points into your investments. This is natural because this is how most people earn money in paychecks. And it's a great way to build up investments over time and invest when the market is high, but especially invest during times when the market is low. Which leads me to my final point on this slide, which is I hope that you see these dips as an investor as opportunities. Because if you've been investing in your 401k, now you're investing at stocks at a 10% lower price on average. That's a good thing because we're not selling those stocks now. We want to sell them much later. So the lower price you can get into, the fact that it is, quote, on sale, that's better for you. If you have dividend checks coming in that are being reinvested into companies, well, that's now buying more shares if the share price has gone down. If you work at a company that has stock-based compensation and you're about to get an RSU renewal, well, they're probably going to look at the stock price falling. They're going to want to retain you as an employee and you might get some more shares. So these dips are opportunities, not just for you as an investor, but for us to look at opportunities within your financial plan to rebalance, to do tax loss harvesting. And those are nerdy things that we can talk about if you want me to talk about them in a future video. But as your financial advisor, my goal is to put you in a position where we're not just talking about investing, but we're looking at your investments as part of a broader financial plan, looking at all of your money. That's a big reason why the company is called Redwood Money, not Redwood Investments. So here are a few firm updates for Redwood Money. The first one is a little communications housekeeping. I have a new work cell phone. It's 408-617-8757. So if you have my personal cell, that's great. I would just ask that going forward for anything related to your financial plan, please reach out to me at this number. It's really important due to regulatory stuff and just for good housekeeping that I keep the business side and the personal side completely separate. So if you have a financial planning question, it's so important to me that you be able to text me. I love texting. It's an important way to communicate with clients. So you can text me at this number and just leave it off of our personal text thread. And then I would also ask if you have referrals that you give them either this number or my jeff@redwoodmoney.com email address. And that way, from day one of working with me, we've got those lines of communication really clearly sorted out. The second update is that I'm managing investment accounts at Betterment. So Betterment is a really powerful platform that allows me as an advisor to manage assets for you as clients. And I'm able to do that at a low cost relative to the rest of the industry. And for most of my clients, I'm not going to be managing all of your assets. It doesn't make sense, for instance, for me to be managing a employer-sponsored 401k plan or a company stock plan. And we're going to make sure that you're contributing to the best and most efficient accounts for you and your financial situation. But sometimes that could mean opening up an IRA, a Roth IRA, a taxable brokerage account, or a trust account that I can manage, where I can help you to optimize your contributions, your investment strategy, maybe do backdoor Roth conversions. There's a lot that I can do within Betterment around the edges of your financial plan to manage it effectively. And they have just a beautiful, intuitive user interface, which is really important to me, that allows you to see what's going on within your investments. It allows me to also stay on top of it and be proactive in helping you with making smart investment decisions. If you have questions about that, you can reach out to me and we'll also talk about it during financial planning reviews. The third update is that Redwood Money is growing. Coast redwood trees actually grow the most vertically in the first 50 to 100 years of their life. And so even though they can live for thousands of years, they'll probably reach their terminal height in those early years. And they'll do that by growing 2 to 3 feet per year. And I feel like just in this first month, Redwood Money is in this really big growth spurt. And it's been so exciting to see as I've gone from filling out tons of paperwork to onboarding clients. I actually got to onboard 10 financial planning clients during the month of January, and I've got another 10 lined up to get started with as my capacity increases. We've talked about this, I'm sure, but my goal with Redwood Money is not to become a mega firm. At this stage, my goal is to get to 50 to 75 households that I have a retainer ongoing financial planning relationship with by the end of next year of 2023. So I'm ahead of pace right now, and part of that's just this backlog of friends and family who have already said they want to work with me, and I'm really excited about that. I want you to know that if we're working together, it's because I handpicked you as a client. It's important for me to be able to work with you and also to give you a great client experience. And so that's why I'll be managing growth going forward. And I say that because I really appreciate referrals and I've been getting those. I'm happy to receive those and talk with those folks. But if you can just help me out by setting the expectation that I might not be able to actually get started with someone until maybe the middle of the year at this stage, as I work through the backlog of people who already want to get started with me and make sure that I continue to deliver what I know you expect, which is a really high touch financial planning model where we're communicating regularly and I'm on top of not only doing the information gathering, but delivering your financial plan and implementing those financial planning action items. So send referrals, but set expectations appropriately. The final update I want to give is a personal update, this little cuteness update. That is actually why I'm not in the photo. We got Jordan and Sophia up in Tahoe, and we went up there with her family this last weekend and had such a wonderful time just spending time together and seeing Sophia be super confused as she touched snow for the first time, exploring together. And to me, this is so meaningful because the point of financial planning, the point of all that we do together is not to just accumulate money for money's sake. Money is truly just a tool to enable you to lead a life that is well lived, that's meaningful, that's in accordance with your values. And if we can make efficient money decisions, it makes things possible that wouldn't be possible otherwise. And so travel is important to me. I've been hearing that from a lot of you. I think especially after COVID, where over the last couple of years, it's been so difficult to travel and many plans have been disrupted. It's important to us. And I wonder what's going on with you. And so as I close out this video, really a couple of asks. The first one is subscribe so that you can get my future updates. And the second one is let me know what's going on in your life and your family. I want to stay up to date. So shoot me an email at jeff@redwoodmoney.com. Would love to get a little personal update on what is new with you guys. Thanks. Bye.